Welcome back to the Main Street Meets Wall Street podcast. I'm your host, Marcus Sturman Sr. Today's guest is a colleague who perfectly embodies our mission. He's a CFA charter holder, a leader within the CFA Society of Atlanta, and a seasoned investment strategist with a career spanning firms like Invesco and Prime Boat Cycle. More dedicated, he's a dedicated mentor to the generational financial advisors coming into this world. Without further ado, I'd like to introduce you to Mr. George Hauptfuhrer. Hello, Mr. George. Welcome to the show.
Marcus, it's great to be with you. I appreciate the invitation to do this.
Yes, thanks for having you on. We have a lot going on in the world today, so I'm not sure if you had a chance to check out the podcast. What we like to do here is we like to take a little bit, just talk about current events, and then we'll speak about a little bit about your history and where you've come from, how you've seen a lot of this stuff before. So we would love to catch some of your knowledge and wisdom in that perspective. Just look for a wide range conversation. So I guess people always say that history rhymes, but history doesn't repeat itself, or maybe history repeats itself, but history doesn't rhyme. What's your perspective on it, and what does today's environment look like to you compared to historical times?
That's a great question. Certainly, there are things that we should be able to learn from the past, but I think every situation is a little bit different. And today, that war in Iran is a factor that we haven't really seen anything similar in my lifetime, although we have had previous Gulf wars. I think the other thing that's a little bit different today is the fact that we're about to get a new Fed chair, and we don't know exactly, what his point of view will be, with perhaps a bias toward trying to reduce the Fed funds rate, short-term rates, but with inflation still above 2%, really closer to 3% today, there's not too much I think the Fed could or should do in lowering rates near term. So I wouldn't be surprised if the market just treads water for a while now. Earnings seem to be pretty good. That's always a key factor as well. I think one thing that I've hopefully learned in my career is to try to remove the emotion from the investment decision. In the final analysis, corporate stock prices are a function of earnings and earnings growth, and then whatever PE multiple you put on those earnings. As I mentioned earlier, earnings have been coming through pretty solid. That could change if the war in Iran lasts longer than most people expect, and if oil prices go from the current $100 per barrel range up to 120, 130, 140. We could possibly be facing a recession, not just in this country, but in a lot of the G7 and other countries that we trade with. So that's a wild card. And to me, another lesson I hopefully have learned in my long career is the importance of being diversified, not putting too many eggs in one basket. And so whether you're talking about stocks, where I think it's important to have a non-U.S. allocation as well as your U.S. allocation, but also within the U.S., have your large cap, your mid cap and small cap, but also have a good style balance between growth and value. And when you see one area of the market significantly outdoing the other, I think a good discipline is to trim back your winners. In this case, mega cap growth names have really dominated the U.S. market for most of the last 5 or 6 years. And so I just think it's prudent to trim and take some of those gains and rebalance into small, mid-cap, value-oriented names. My comments apply more to institutional investors, where you don't have to pay a tax on capital gains. When you're thinking about retail or individual investors, where you do have to pay a tax and then you're reinvesting 75 cents on the dollar, that can be a different issue, because you have to be even more convinced that whatever you're trimming is not likely to continue to do so well, outperforming the rest of the market, and whatever you reallocate those funds into is likely to do better. So it's really a twofold decision when you make that kind of rebalance as a retail or individual investor.
Yeah, that's a great breakdown. People tend to forget about taxes when they're when they're investing or even when they're preparing for retirement, they'll have a lot of their money in pre-tax accounts, and they'll retire and they'll pay Uncle Sam. They'll take out $100,000 to give Uncle Sam 40,000 of it or something. They're really upset of it but Uncle Sam's really happy that you just retired. So you were mentioning your strategy, a good approach with the diversification, and you actually were mentioning the barbell strategy, whereas if you see growth start to get too heavy, maybe you move a little bit heavier to value inside of your investment strategy. Inside of that, you mentioned that you were referring to institutional investors. That's the level you worked at before. Can you go a little bit deeper into that as to like some of the differences because people always see institutional investors as having the advantage, but there's a lot of information now for retail investors. What kind of information or what kind of advantages would you say institutional investors have that retail investors don't have?
Well, number one, institutional investors can access alternative assets like private equity, private real estate, private credit, and hedge funds, direct hedge funds, as well as fund of funds in a way that most retail investors are unable to do, although there is now an increasing number of what we call evergreen funds that have lower minimums that retail investors can go into. The firm that I've just retired from, Prime Buckholz, does not currently recommend any of those, but I know the research department is looking into that as a possible solution. So the first thing would be the breadth of assets that you can tap into as an institutional investor, especially those where the minimum could be as much as $5 million. Was at Prime Buckholz, we had plenty of accounts that were, 100, 200, 300 million or so. And so it was not too difficult to allocate 5 million to meet a particular alternative asset manager's minimum. The second thing that I think institutional investors are able to do, which most retail investors find more challenging, is take a really long-term strategic view, and be able to ride out the inevitable ups and downs in the stock market. I think retail investors tend to be a little more influenced by short-term swings, and they're more emotional in making their investment decisions. If something goes down sharply, say 20%, they might be more inclined to sell it, whereas an institutional investor might add to it. If they liked it at 100 and it's now selling for 80, why wouldn't they like it better if the fundamentals are still intact? That's a big if. But I do think institutional investors think longer term. They're not likely to be tactical the way some retail investors may be inclined to be.
Gotcha. Yeah. So the mindset, first of all, like you said, that just the different types of investments you have access to, the mindset is very important as well. So when you mention like the dips of 20%, we actually saw that last year when we saw the market go down 20%. So I don't know. I'm not sure how much institutional investors bought back into that dip. I know retail investors purchased a lot of that dip last year. That's why I was saying it seems like there seems to be a shift inside of the institutional versus retail investor mindset. Do you think the democratization of information has made the retail investor, do you think retail investors have the exact same information now as institutional investors? I know like back in the day, people could go out and count cars in parking lot, like those type of things that retail investors weren't doing, but institutions were doing. Like, what do you think that the information level is now?
Yeah, I think the difference in terms of information has really narrowed over my career, which goes back actually 45 years. So it's a more level playing field now. And I think institutional investors, just given the resources that they can bring to the analytical process, still have an advantage. But I think retail investors have narrowed that advantage by what's available, online and through other sources. I will say that there's another important distinction in the investment world that might be worth making, and that is momentum investing versus what I might call contrarian investing. And, momentum investors, if a stock goes up, they may buy more of it. They're going to think that will stay in motion positively. Whereas a contrarian investor, in the example that I gave a couple minutes ago, if the stock goes down and the fundamentals have not changed in any material way, In other words, key personnel at the company and positions in their market, haven't changed. That makes it a more attractive stock. So you have those two schools of thought, and I think it's a challenging balancing act for most investors. So you don't want to be always playing the momentum game or always being a contrarian. You can get burned either way. As a contrarian, for example, and I had this happen to me once or twice when I was at Invesco, and we had a discipline of, adding to losers if we thought the fundamentals were still intact. And, a stock that goes down 20, 25% can go lower. It's like trying to catch a falling knife. You can be burned or cut in this analogy by thinking something is likely to rebound and then it doesn't. So it goes back to what I said about being well diversified. When I was at Invesco, our average client portfolio had 50 names in it, and each position was in the neighborhood of 2%. Some might have been 1, some might have been 3, 3.5. But in general, we wouldn't have any position be 6, 7% or so. And I think the average investor today probably doesn't realize that if they own the S&P 500 index, they've got 7% in NVIDIA as one stock, and then they've got a pretty large percentage in Microsoft and Apple and other mega cap stocks. You can buy the equal weighted S&P. I think my old employer Invesco offers that, among others. And that way, if there's a rotation and the smaller and mid cap stocks do better, you'll do better in the equal weighted S&P as compared to the traditional cap weighted S&P. But I think that's enough on that particular tangent for now.
Yeah, and the Invesco fund you're talking about, the RSP, the equal weight, has actually been outperforming this year until it recently started to change. And yeah, people don't realize the amount of concentration inside their portfolios. Speaking of, so you said you've been doing this for 45 years, so like 1981, right at the beginning of the 80s. So you've seen different type of markets. You've seen you've seen how hot the market ran in the 80s, and you saw how that ended, right? Like every cycle ends eventually. Right? What do you look for in cycles? Because people think we're in an AI bubble. What should we be looking for as to maybe this cycle is run hot? Is what we're seeing right now a signal that this cycle's in, or is this just something in a longer rotation cycle?
Yeah, you don't really know where you are until you have the benefit of hindsight down the road. But I will say the period at the end of the 90s, 98, 99, going into 2000, was a pretty clear bubble. So at Invesco at that time, all of the portfolio managers could pick from a purchase list, an approved list that had, 80, 85 names, and we would circulate the statistics of the client portfolios quarterly. And I realized as we were moving toward 2000 that the average capitalization of my client portfolios was a little bit lower than those of my partners managing, the same U.S. Value equity, core value. And that was because I felt like, Cisco and the other mega cap names were ahead of themselves, that the current and future earnings didn't justify the prices at that time. So I was migrating down into the mid cap space and lagging the S&P 500 as it continued to go up. It did turn in, the first quarter of 2000, and the small and mid cap did outperform for the next couple of years. So I was a bit early, but I think my inclinations were correct. And so bringing that up to 2026, it is hard to know about the impact of AI. We've already seen some of those, so-called Magnificent Seven stocks benefiting from that. And no doubt it is changing the way a lot of companies do business, I think for the better. And it's unclear, at least to me, whether that's going to result in the aggregate employees being laid off or the need for new hiring. Most people think it'll result in layoffs, net layoffs. But I think the jury is still out on that, and will tell. But there does tend to be a little bit of, I would call overhype in areas such as AI. We've seen that historically in other areas. You've probably heard about the so-called tulip mania in the Netherlands, several centuries ago now. And, whatever the product or commodity might be, there's usually a limited supply. And then when the demand takes off and the price takes off, you have to be really careful. I think it was probably Warren Buffett who said that when others are greedy, be careful. And, when others trash a stock, take a closer look because there could be a buying opportunity. So that goes back to what I was saying earlier about being a bit of a contrarian. And I think the part of Invesco that I was involved with for those 14 and a half years was more in that camp where we would be trimming our big winners and we might be, adding to our losers.
So y'all were in constant rebalancing, more actively managed at that time than most accounts.
Yeah. I was at Invesco just when passive management was starting to become more and more popular, primarily through firms like Vanguard that offered all these indexes at a really low fee. And today, you can get a lot of their indexes at 3 or 4 basis points. When I was at Invesco, and I don't know about today, but we would charge, I think it was 75 basis points on the first 10 million, 50 on the next 10 million, and 25 basis points above that. And if you had a really large account, you could negotiate that. But that is a headwind for active managers compared to the low-cost index funds. Now, that said, my younger son is at T. Rowe Price, which has active orientation and a great long-term record, depending on whether you want to look at, 5, 7, 10 years or what have you, at pretty reasonable expense ratios. And active managers in general will lag strong markets and then outperform in flat or down markets. So in a full cycle, you tend to have a smoother ride. And a lot of investors prefer that smoother ride rather than the more volatile ups and downs that you see through.
Got you. And like you said, so in that situation, when you have the actively managed fund, it's going to be a higher fee. You're looking for some delta inside, just maybe the way you're actually managing the fund. You're finding different accounts, different stocks. Like you say, your contrarian view, you're going to catch stocks that are low, and then when they come back up, it's going to make up some of that change that you're not getting or for that you're charging extra fee. People will pay extra fee if you can show them that you're worth the fee. I want to pivot a little bit here, but we'll talk about Kevin Warsh. I know you were speaking about the Fed. We're entering into our situation right now. So with new Fed chairs, you've seen several of them in your life. They always seem to get tested by something. Something happens in the market when the Fed chair comes in. Right now, it looks like one big thing is going to be whether Warsh is, when he gets put into office. I'm up here in North Carolina. You're in Atlanta, so I said up here. But down Wall Street South, and Tom Tillis is holding up the process right now until he gets some more clarity on Jerome Powell. But Kevin Warsh is coming to a situation where we have global geo tensions at a really high level, oil disruption at a really high level, and then the national debt at like a serviceable national debt of above $160 trillion. How can Warsh approach this? Do you think he'll approach it? And then how can Main Street investors approach this? That's a big question.
Yeah, that is. I could go a number of different directions there. I did have the pleasure of listening to Warsh at the Atlanta Society Annual Forecast Forum, February 4, I think it was. And he did a good job. He's a veteran of the Fed and been around to understand all these cycles. The Fed chair, when he or she meets with the media every 7 weeks or so when they have their 2-day meetings, has essentially a bully pulpit that they can use to lecture in a nice way Congress the way they, spend, beyond our means and have that kind of annual deficit and cumulative deficit that you mentioned, which is now more than 100% of the U.S. GDP. I do worry about our kids and our grandkids, inheriting that problem, because just servicing the debt is taking a bigger and bigger slice out of the budgetary pie. And so that leaves less for other important areas such as education. I do think Warsh will be approved. I understand Senator Tillis's problem with commentary about, I think it is really surprising that he presided over spending so much money on that new Fed headquarters in D.C. I think that's not a good legacy for him. But I think we should drop, whatever litigation there is at this point. And hopefully, even though he could stay on the Fed after Warsh becomes the new chair, I kind of hope he steps aside so that he's not in any way looking over the shoulder or second guessing the new chair. I think the Trump administration or any president of whatever party should allow the Fed to be truly independent. I think Trump has spoken, overly critically about the Fed. I mean, it is true that Powell was wrong saying that inflation was transitory, back in the end of 21 and going into 22, as inflation hit 7, 8, even 9%. The Fed, again, hindsight's always 2020, but the Fed should have been raising rates pretty aggressively back there in 22 so that inflation never got to be 8 or 9%. I'm not aware of the Biden administration trying to exert undue influence going into the midterm elections in 22. Maybe they did. But again, the Fed should be independent. So I am glad that they're serving, to the best of their ability. I think some of their models may be outdated, overly focused on historical data in an economy that is changing rapidly, like you were saying before, with AI. So maybe some of the dated models need to be replaced with new models. Maybe they don't need quite as many PhD economists, working off the Fed. Maybe there's an opportunity to save some expense there. But again, I think independence is important.
Perfect. Yeah. And just for the record, Jerome Powell isn't a PhD economist. He's like an attorney, I think. Like the way he's trained, an attorney and a guitarist, right? Yeah. So Warsh will definitely come in with his hands full, to say the least, historically. And like you said, he was there for 2008. So he saw that whole financial crisis as well. So he's seen the playbook, and he's definitely a proponent of trying different models. He wants to try different type of models and new systems for data. And people hear this on Main Street all the time when you're referring to models. Like, which particular models are you referring to that may be time to put out the pasture?
I don't have anything in particular in mind, Marcus, but, back 30 or 40 years ago, there was a term that was coined called the Laffer curve, named for Art Laffer, who served while Reagan was president, and he continues to be a contributor on Fox Business with the Kudlow show, led by Larry Kudlow, who was an advisor to Trump during his first term. That talks about the trade-off between inflation and unemployment. And I don't think what held true a number of decades ago is still as true today. But I'm sure there are better examples that I just can't think of. By the way, I did have the pleasure of meeting Jay Powell, and he was a client when I was at Prime Buckles, and he was on the board of a school in D.C. where he lived. And so report to him, and he recognized my last name, which is pretty unusual because of going to the same college as my brother, who was a pretty good basketball player.
Really? So your brother used to dunk on Jerome Powell. That's awesome.
I don't know if they had any one-on-one opportunities, but my brother was 6'7", or is 7.5", and he has bigger hands than I do. So I think he was able to dunk, although I don't know if he ever did that in a game. I'll have to ask him next time we talk.
Dunking wasn't quite the thing back then, but yeah, 6'7" with big hands. And your last name is Hauptfuhrer, so fewer hops, as we said offline beforehand. It's very cool correlation. Very cool story. I want to talk about the flight that we've seen. People have mentioned taxes in like New York. People are talking about increasing taxes in like states like Washington State now introducing personal income taxes. And in general, maybe not so much for the taxes, but we're down here in the Wall Street of the South now, right? Charlotte has become the second largest economic center in the world. Atlanta's starting to grow. The Southeast is just becoming the Wall Street of the South, and Texas as well is starting to grow. What do you see? Because even before the taxes were becoming an issue, this flight was already starting. Did you see anything that led to this move, or that you've seen why people would want to move down here to the South?
Well, I think the climate is preferable for a lot of people compared to the New York area. It's interesting. I don't really want to get into politics, but, New Jersey, New York, and Connecticut are very blue states. And New York City is a very blue city. And it now has a mayor that I guess is
He says a socialist.
Exactly. So for people that are more middle of the road or to the right, maybe they feel like a purple state like North Carolina or Georgia, or a red state like Texas or Florida is more appealing, in addition to the fact, or related to, the taxes being lower in these, southeastern states.
Gotcha. Yeah. Yeah. I feel like it's probably more of a, I don't want to have just conjecture here, but like more with the taxes it is with the political belief. Because I think at the end of the day, like you said, these are institutional investors. So you all know, like at the end of the day, your returns and your stocks and bonds, it doesn't matter the administration, whether it's red or blue. Like history shows that the stock market goes up and to the right pretty much throughout the history of time. So people making investments based solely on, red or blue, they're really missing out on it. They're really missing out on a lot of stuff.
You've just raised another issue there, Marcus, which is the pitfalls of market timing. Since the market does tend to go up long term, you got to be there to have that ride. So, when you have the inevitable downdrafts like we saw at the end of 2008 going into 2009, or with COVID, back, at the end of the Trump first term, it's really a buying opportunity rather than a time to look for the exits. So again, it's a caution for especially retail investors who might be inclined to, throw up their hands and raise more cash. But for my client, when I was at buying Buckholz, and we had that downdraft, both at the end of 2008 going into 2009, and again with COVID. Even a year ago, April of 2025, the tariffs were announced and the market, went down a double-digit percentage. It was an opportunity to buy more at attractive prices. And so if we didn't have a regular meeting set up with clients, we would call a special meeting to give our recommendations and move forward in that kind of rebalancing.
Nice. So y'all historically bought the dip, and your clients, you called them, educated them, which is a very important part of it, to let them know like, hey, this is going to go up and to the right. And I imagine some of your clients already knew that you were going to buy the dip. You probably didn't even have to call them because you've done it before for them. It's very, very great point. Time in the market. People trying to time the market, you're going to miss the best 8 days of the year every time trying to time the market. Just going back to, so speaking back 45 plus years, what was it like to be in the industry in 87, 88? There aren't very many people out here, like right when the market went down, like Black Monday, like when that happened.
Yeah. Well, I had not seen such a strong downdraft before. I had some good summer jobs in the early 70s, where the market was, flat and then generally down, especially when Nixon ended up having to resign in 1974 because of the Watergate crisis. He would have been impeached, but he chose to resign, before that would have happened. And the market was really in the doldrums then. I wasn't, an investor then. I was not making any money, but I remembered that time as being a good buying opportunity. And the same thing toward the end of the Carter presidency, when we had Americans taken hostage in 1979 in Iran, which is when the current regime took hold from what had been the Shah. And, we had real malaise in the U.S. and, gas prices rose and inflation rose. And I remember President Carter having a fireside chat, dressed in a sweater with the fireplace behind him, asking people to turn their thermostats down, and in the wintertime and, just do everything they could to conserve energy. I mean, that was a tough period, especially for check to paycheck and had to get gas to drive to their jobs. But I think the Reagan years were a wonderful growth period. And then, Bush 41 kind of continued that. I think the Clinton years were actually very good for the country. That was the last time that we balanced. To his credit, was able to work across the aisle with Newt Gingrich of Georgia, who was the Speaker of the House on the Republican side back then. And there was a collegiality in Congress that we really need today, that we haven't seen in a long time. But anyway, let's see, after Bush 43, and, his presidency was marked by 9/11 early on in 2001. And, another really tough state election in 2004. So the country has been so evenly split ever since then. And the partisanship has gotten worse and worse. And I don't know what it's going to take to get people to, especially Congress, to listen to one another and be willing to compromise the way they used to back in the 80s and 90s. But it's, in my opinion, something worth praying for, because I think our whole country, the morale of the country would be a lot better if we weren't so evenly split in ways that can be very evasive.
You got that right. This country is so divided right now. We're just red or blue. I think if you even look back, like you mentioned with Clinton, like historically Clinton, his politics and his views, now he'd probably be viewed as a Republican, right? Just based on, especially like his economic policy, some of the law enforcement policies he put into place. And then you go into all the presidencies you mentioned, all of them saw like the cycles, right? So they all kind of had wars in between those times, like 10 years. People talk about the market goes up 8 to 10% every 10 years, right? Historically. But they tend to forget that the market has those down times, right? So you have the late 70s, the whole 70s, right? You have the 70s that were just pretty much terrible. And then you have in 79, like you mentioned, when with Iran, the leadership was that it was because we took in their king or something, correct? Came to our country for medical treatment. So that started a whole big thing, and then just led to, so there's cycle. What I'm saying is inside of all these, there are always cycles. And I know you focus on some dividend growth type strategies. So this market relates to part of it probably the 70s and 80s, part of it probably the late 80s, part of it probably even like the 90s and the boom and bust of the .com. How would you suggest Main Street tries to find balance and invest in this type of market? You don't have to give like specific names, but just like, I know you mentioned diversification earlier.
Yeah, well, I guess my time at Invesco ingrained into me the importance of buying stocks that do offer a dividend. And so, I've missed, other than through an S&P 500 index, I've missed some of the really strong growth stocks in recent years. But personally, my rule of thumb is to try to get a yield that is at least in line with the money market fund, So, because otherwise you can just put it in cash. But a lot of companies will increase their dividend every year or two. And so if you can get a solid company that has a solid balance sheet, good free cash flow, and the yield is, say, nowadays 3.5%, 4%, with the possibility of that dividend being increased. And then, as important or more importantly, capital appreciation on top of the yield, then your total return can be in that 8, 9, 10% historic long-term average. And I think it is important for Main Street investors to realize that total return is a combination of the yield and the appreciation. Of course, the appreciation could be depreciation, but still you have the yield. And so I think there should always be a place for dividend stocks in most portfolios, if not all.
Perfect. Yeah. And inside the yields, you mentioned like if the appreciation doesn't happen, that generally means that your yield's actually increasing, but that might not be the best. That might be the best thing because then maybe they can't cover that dividend at the end of the day. So that's probably something you're looking for. What factors are you looking for inside of a company to see if they can actually cover that dividend that they're offering?
Well, I think number one, you look at the balance sheet. What is the debt to equity ratio and what is the current ratio, current assets to current liabilities? So how strong is the balance sheet? And number two would be interest coverage. How well covered is that debt? We're talking about interest coverage. It's usually EBITDA, earnings before interest, taxes, depreciation, and amortization. And then number three would be the payout ratio. If you take the dividend per share as your numerator, the earnings per share as your denominator, is that payout ratio reasonable? And what is reasonable? 40 or 50% certainly is more reasonable than 60 or 70%. But as I alluded to in passing earlier, I think free cash flow is actually more important than stated regulatory earnings. So, how much does a company have in the way of depreciation, amortization that's not being plowed back in terms of capital expenditures to that company and available for share repurchase or dividend increases? So all of those factors, I think, are important at getting comfortable with a company's dividend policy and current payout.
Very good. So those are definitely some good factors to look at before you're picking a dividend stock or any type of fund that pays a dividend. People should always remember also that you do pay taxes on dividend. Unless you have your dividend inside a Roth account, then you won't pay taxes on that. Just speaking, so we were at a conference recently, we were talking about different kind of assets and asset allocations. One of the topics there were physical assets, gold. I know gold versus crypto has been a big thing, and I don't know how deep you want to go into maybe crypto, but what are your thoughts on just like the move back? Because we're seeing a move back to hard assets, right? People are buying art, people are buying collectible cards, baseball cards. So gold, like real assets, real estate. Do you see that move as a permanent move, like a longer cyclical move, or do you think that's just something that's kind of happening quick?
Yeah, I don't feel well educated to be able to answer that question. I can just tell you that when I was at Invesco, even though I did have some high net worth clients in addition to institutional clients, and the same thing at Prime Buckholz for the last 19 years, there was not a lot in the way of collectibles. More recently, there were people dipping their toe into the crypto. When I was at Prime Buckholz through a couple of different funds that were, again, pretty well diversified, so you didn't have too many eggs in one basket. I will say personally that I have followed a company that used to be called MicroStrategy that is now called Strategy, and they have 3 or 4 different preferred issues. And because of my interest in dividend yield, I did buy one of those preferred issues, which was selling for about 82, 83 at the time, and therefore yielding about 12.5, 13%. But the stock has gone down. It's now in the low 70s. And so if they continue to pay the stated distribution, the yield is now 14.5, 15%. But whenever you see a yield that's that high, I think the market is telling you that there's above average risk that distribution may be cut. And in this particular company's case and the preferred issues that I'm referring to, it's going to trade, I think, pretty close to the underlying price of Bitcoin, which is down significantly from where it was, 12, 18 months ago. Is it going to rebound anytime soon? Who knows? Trump himself seems to be a fan, and I think the Treasury Secretary Bessent is also supportive, and it does seem to be getting traction outside the U.S. So, I tend to think it will rebound at some point. There is a finite supply level. They're not creating that many more Bitcoin going forward. And so it doesn't take too much increased demand for the price to move up just because of the microeconomics, supply and demand factors. So I'm going to stick with that. Although if it doesn't move much before the end of the year, I can realize that loss to offset a gain and minimize my taxes.
Perfect. And that's a great example for people. So people on Main Street, if you want to invest in maybe some type of crypto, there you go. You can find a fund, because anyone can go buy this fund he's talking about. Just go buy it. There's a ticker for the fund. Just go buy that fund, and then at least you're getting some type of dividend on the backside of it, where you're getting paid back on it. Even if it goes down, you're still getting some returns, and know when to get out. He has a plan for when he's going to get out. Another big thing that you mentioned, George, inside of that at the end, you said, I'll probably hold on to at least the end of the year. You're going to get this investment time. If you're going to buy something, in my personal opinion, you want to hold it for at least, and this isn't investment advice because everyone's investment advice is different, but if you're investing, you want to hold it for at least a year. You want to give that thing time to see what it's going to do. Also, it's going to change the way it's taxed. Capital gains, long-term, short-term gains. But you want to give it time to see how it reacts to different cycles. Shouldn't be jumping in right now making like drastic moves or anything. That's just something I wanted to put out there for Main Street.
Yeah, unless something is fundamentally broken after you buy it, one or two key executives leave the company, or maybe it's a healthcare company that expected to get final FDA approval of something and they don't get the approval, and therefore the forecasted earnings have been cut. There's any number of different factors that could fundamentally cause you to sell in less than 12 months. But I think that's the exception rather than the rule. And that theme reminds me that Warren Buffett, again, just wonderful, longtime investor, as we all know, he is famous for saying, a lot of times you win by not losing. And so that goes back to what I said early on about the importance of diversification. And it also reminds me of a little question that I would ask when I was doing interviewing, either on behalf of a company that I was working for, or perhaps, somebody who was looking for a recommendation to get into the MBA school. I would say, and some people would get this immediately, and some people would have to think a little bit, but I would say, well, if you own stock A and it's $100 and it goes to 50, goes down 50%, what percent increase do you need to get back to where you were, to break even? A lot of people immediately would say 100%, and that is correct. But, some people would have to think about it, but it's a good illustration. A percentage decline hurts you much more than the same percentage helps you on the way up. So protecting against the downside, I think important. My brother, who lives near where you are in Charlotte, Marcus, does not fully embrace that philosophy. He may have a hub and spoke approach with a small index fund at the hub, but then he'll have as few as 7 or 8 stocks around that hub that he knows inside and out. He's following every press release. He's talking to the CFO or the IR person. And the average Main Street investor doesn't have the time or necessarily the background to do that. My brother is a JD MBA and has great experience, and, he's got the time, and he loves doing it and has done really well doing that. I think that's a great formula for building wealth. But once you have wealth, to me, it's better to diversify and lower your risk profile to preserve that wealth.
Right. That's a great point too. And even as you mentioned with Mr. Warren Buffett there, who probably is one of the greatest investors of our lifetimes, he believes in diversification, but he doesn't have as many stocks as people would think. He has a fewer amount of stocks that he's really concentrated in, and he knows them inside out, like your brother. So for Main Street, before we go off here, I know we have to run soon. You kind of opened up the box about how concentration versus diversification in the long term. Like, so if you're changing, like you mentioned, you just retired here recently, I'm assuming, right? Last year or maybe this year, you just recently retired?
It was the very end of 2025.
Congratulations on that very fresh retirement. I know you're still trying to figure out what to do with yourself. You don't have too much of a honey-do list. But inside of this, someone who just retired in 2025 and now they're in 2026 in your position, maybe not same financial position, but just in your position, what should they think about, or someone who's about to retire 25, 26, as they go from that accumulation to that to the stage where they're spending money?
Well, as you well know, Marcus, everybody's situation is unique and, different from everyone else.
Mm-hmm.
So you need to consider the specific circumstances and risk tolerance and so forth. But there's been a development in the last, 12 or 15 years, which I think may apply to a lot of retirees, either right before or when they retire. And that is target date fund. And so you can pick a fund, whether it's at Vanguard or another firm, that has a particular asset allocation for those people that are expected to retire in 2030, 2035, 2040, 2045, 2050, pick whatever year you think you're going to want to be lowering your risk, and it will automatically rebalance every year or two, reducing the equity allocation and increasing the fixed income allocation. And so that's a really easy, low-cost way for people to be setting aside money for their own retirement or for other loved ones. It could be somebody listening to this podcast on behalf of their parents, or an older sibling or just a good friend. But again, the major fund companies offer those target date returns. I know T. Rowe Price, with our younger son works, also has a similar program. Before we run out of time, if you would permit me, I'd like to also offer one thought as people on Main Street do well in their careers. And we certainly wish everybody to do well. But one thing that I did when I had the good fortune of buying a little bit of Intel stock back in the mid-'80s, when I was at, a different firm, actually right before I joined Prime Book called Invesco. But I bought some Intel, maybe only 100 shares, but it, tripled or quadrupled over the next few years. And then my income was also rising. And I decided, instead of, meeting my church pledge by writing a check every week, I would just peel off a little bit of the Intel stock and give it to the church. And that way I didn't have to pay a gain on the stock. The church got the same amount of money. I didn't have to mess with weekly or monthly, checks. And it was really simple. And then fast forward a few years later, and my Intel continued to do well. And I had one or two other stocks that were doing well, and had some charities that I wanted to support in addition to my church. And I peeled off some low cost basis stock and sent it to the donor advised fund at Vanguard. DAF is the acronym that some people use. And back then, and maybe still today, to open a DAF account was $25,000. The beauty of doing that is you get the deduction in the year that you give that stock to the, donor advised fund. And then you can direct that fund to make gifts to your church or your alma mater or whatever 1C3 beneficiary that you choose. And I just do that online. It is so simple. And our kids have grown up knowing that I do that. For those of us who have been blessed, we should be a blessing to others. And I obviously feel strongly about that. So thank you for allowing me to share that.
No, thank you for sharing that. And yeah, take a second. That's good stuff. The donor advisor fund. People don't really realize that you can, when you have gains in these stocks and concentration risks, that you should give this stuff away. That there are ways that you can give it away and still you still benefit yourself, with the tax benefit, but you're helping causes that you're going to help anyway. You're going to give this money anyway. Has that rubbed off on your children? Are your children giving people as well?
Well, every year, my wife and I asked them, who would you like to give money to? Part of the reason I got emotional was I was thinking about our oldest grandchild who was diagnosed with brain cancer when she was age 7 and went through 3 surgeries, brain surgeries, chemo and radiation and so forth. And we wanted to be grateful to St. Jude Children's Hospital in Memphis because they flew Charlotte. And I wear this band on my wrist to remember Charlotte. And you can remember her name since you live in the Charlotte area.
Mm-hmm.
But anyway, they flew Charlotte and her mother, which is our daughter, and continue to fly her down there for her periodic scans to make sure the cancer has not come back. But they gave her all that treatment. They put them up at night, feed them, without charging anything. And they do that for kids, not only around the U.S., but now coming from different countries. And so I remember the celebrity that started St. Jude. His name was Danny Thomas. And you may have heard of his daughter, Marlo Thomas, who has continued to carry the torch for children's cancer research and cancer treatment. And talk about legacy. That all started in the late 1960s. So that's, 65 years ago. Back then, childhood cancer had a survival rate of 20%. 80% would not make it. Today, those numbers have flipped where 20% don't make it and 80% survive with good quality of life. And so far, our granddaughter is in that category. Our daughter knew that we would want to use the donor advised fund at Vanguard to thank St. Jude for being so generous to us. And we've continued to support them. In fact, there's an event that I'm just now signing up for in Atlanta, which will be, I think, April the 16th at the Intercontinental Hotel in Buckhead that we have been to in the past and will be there again this year. Our daughter knows that and her brothers know that, and they're all very supportive. And so that's one example of where we are involving the kids in our charitable giving.
That's very good, Mr. George. I appreciate that. I appreciate you sharing that. Yeah, and people should realize, when you have both your hands gripped like this, you can't ever get anything back. You got to let that stuff go. It comes back. You know what I mean? It all kind of works itself out in the long run. Like you said, you've been giving to charities throughout life, and then you really needed that for your granddaughter, and St. Jude's is there. It's beautiful stuff. I guess I know you have to jump off the call, so if there's anything else you want to tell Main Street, and also where people can find you if you want to be found, if anyone wants to talk to you, where are those things happening, Mr. George?
Sure. Well, I no longer have a work email, so I'll give you my personal email, and that's GJHII@hotmail.com. And if anybody wants to text me or call me, that's fine. 404-313-4115. I would like to mention one other thing, Marcus, just in closing, and that is...
Take your time.
I think, well, let me say 2 things. My career really was significantly aided by pursuing the CFA charter that you mentioned earlier that I got back in the 80s. And it's a lot tougher exam today. Our younger son, the one at T. Rowe, got it along with his Kaya for alternative investing. And very proud of him because the body of knowledge is so much bigger today than when I was tested back in the early 80s. Before, all the alternatives took off and so forth. So I'm glad I passed when I did. But I would encourage anyone who has an interest in the investment profession, whether you're going to try to do it for a living or just for your own personal, investing, consider taking CFA 1, 2, 3. And if you're with an employer, that believes there's benefit to the company for doing that, they should really do. And there is a lot to study, a lot to read to be prepared. And the pass rate is only in the neighborhood of 50% for certainly level one, and maybe it goes up a little bit after that. But I think that's a good thing to put on your resume for whatever you might do down the road. And then the second thing I was going to say is the importance of asset allocation. We've talked a little bit about individual stock analysis, and I forgot to mention earlier, but one thing that I've always used going back to my years at Invesco was the PEG ratio, where you take the PE of a stock and you divide it by the growth rate of the stock. And ideally, you're using the PEG using forecasted earnings, which here we are in March of 2026, would be the forecast for, calendar or fiscal 26. And then the growth rate looking at least 3, maybe 5 years. And the lower the PEG ratio, the better. So, there's no hard and fast rule of thumb. And nowadays, maybe it's better to use free cash flow than it is earnings. But, a PEG ratio of under 1.5 certainly would tend to be more attractive than one that's 2.5 or 3 or higher. But back to asset allocation, the average Main Street investor, I think, would be better served by going into low-cost index funds. And you can do that either through an ETF, which is more tax efficient if you're a taxable investor, or a mutual fund. And so, for example, Vanguard has a world stock index fund. The symbol is V. And again, very low cost. It gives you exposure to the U.S., which is roughly 60, 62%. And then developed markets and emerging markets would be the other 38% or so. I think that's better than buying the mutual fund, because in a mutual fund, you inherit an unrealized gain. And as a taxable investor, if there are net outflows in a particular year, the mutual fund company, in this case, this example, Vanguard, might be selling to meet outflows and realizing some gains. And so you could have a taxable gain at the end of a year, even though your fund value did not go up. It may have been flat or down. So I think the ETF, exchange traded fund approach, is good. So if you want just US, VTI is a good ETF. That's the Russell 3000 domestic. And then if you want non-US, VXUS, I think is a good option. But again, trying to, as you mentioned, I heard your podcast on the brand recently, and you talked about the power of compounding. And that is so true. Set the money aside, try to add to it when you can, and maybe it's through a 401k plan. An employer matches up to 3 or 4%. Definitely take advantage of the employer match and just let it grow. And pounding, by the time I retire, which I just did, I mean, it's a nice chunk of change. And now I have my, required minimum distribution to take the place of my W-2. And so, all is good.
All is good. That's good stuff. Yes, I think that's thanks for watching that episode, by the way, with Sam. Sam, shout out to Sam. This is great advice. Like, as far as with the ETF versus mutual fund, then you actually gave people places they could go and buy these things just to have diversification inside their portfolio. Wow, Mr. George. I could talk to you all day, but I know you have to run. I guess I'm wondering, is there anything else you want to say before we hop off?
Well, let me just check my notes here. You were nice to send me some possible topics. Another thing that really helped me early in my career, in addition to getting the CFA, was I joined the Atlanta Society of Financial Analysts, which we now call CFA Society Atlanta. And it was really easy for me to do at the time because they met across the street from where I was working. And for one relatively low amount of money per year, I mean, I think it was less than $100, might have been $75. They included lunch and a speaker. And it was every Wednesday at noon. And so, I mean, that was a no-brainer. You would just go to the lunch and listen to whoever it was. And lo and behold, back then, this was, 85, 86, 87. I met some of the original 9 partners of Invesco who had left the old Citizens and Southern National Bank, CNS Bank, at the end of 1978. And they were growing rapidly since they left the bank. And they were looking to hire younger people, preferably with a CFA, who weren't used to managing money a certain way, who were open to the Invesco way. And so had I not met great guys like Ed Mitchell and John Morgan and Wendell Stark and others back then, I probably wouldn't have had the great opportunity to join Invesco and be there for 14 and a half years. So if any of your listeners are geographically in an area that has a CFA society, whether you're pursuing the CFA or not, I think they will let you in and let you attend those meetings, which can be very educational, and they're also good from a networking standpoint. So I think that's the only other note that I had made that some of your listeners might find of interest.
Wow. Yeah, that's good stuff. So networking is very powerful. But another thing you got to give yourself credit too, Mr. George, is that once the opportunity was there, you have learned and prepared and you were ready for the opportunity. You have to be prepared and ready to execute on the opportunity as well. People just tend to think that when the opportunity presents itself, you have to be prepared. All right, Mr. George, it's been a great conversation. Main Street, if anyone has any questions for Mr. George, he gave you his information. He's really an open book here. I really enjoyed this conversation. Like I said, I really hope you can come back, hop up on the podcast at another time. We can go deeper, have another conversation when you have time. Until then, I just want to say thanks to Mr. George Hauptfuhrer for hopping on with us. Fuhrer Hops. Main Street, work and smarts, heart meets Wall Street smarts. Thanks, Mr. George.
Been my pleasure. Thank you, Marcus. Be well.